Ladies and gentlemen, good morning. First of all, thank you very much for coming in here today. It's difficult to get to traffic, so I appreciate people coming in, and hopefully it'll be a very worthwhile experience for you. Just to go through, I suppose, introduction myself. My name is Robin Bradley. I worked in AIB Bank for about 34 years. I worked in credit, and then I worked abroad. I worked in private bank, and then I worked in the invoice discounting. I ran the invoice discounting for AIB Bank, and I ran the leasing company. And I'm left AIB now about coming up to nearly 2 years. My colleague Brian Nevin, I worked with Brian in private banking, and Brian after that worked in risk management in the bank himself. When we both retired, one of the things we were looking at doing was that speaking to a lot of accountants, they were talking about the lack of availability of credit to SMEs. And in particular, I suppose, a lack of credit into those companies like the building, the construction companies. We then looked at how we might sort of play in that space, and we went over to the UK and we formed a joint venture with a company called Catalyst Finance. And Catalyst Finance in the UK are a very successful invoice discounting operation. And we did a joint venture with them over here, and that's where we'll talk to you later on about what we're doing with them. We talk about just about ourselves. We would talk about positions of the banks, and again, having worked in the bank, I suppose, for so long ourselves, particularly over the past, in the last 10 years in the banks, the kind of trauma that's gone on in the banks and how that's impacted upon how they've engaged then with their ultimate customers. We talked about specialist contractors. We're going to talk about financing sources again for contractors. And in this group, we're talking about builders, we're talking about mech and elect. We're talking any industry that's related to the construction industry. We talk about single debtor financing, which is one of which is our company, and we'll go through some case examples. And after that, we'll have some questions and answers. I suppose in terms of looking at where Ireland is, and we have a property debt hangover that the banks are dealing with. I suppose the banks were quite traumatised in terms of where it went, undoubtedly in terms of the risk management practices that went along in the banks at that time, that they've had to change completely their attitude towards risk in relation to some of the property industry. The banks certainly have been on a debt recovery focus since 2006, 2007, when they realised the scale of the problem. They immediately had to put a huge amount of resources into getting this because their very viability was at stake. And on that basis, they changed the attitudes. They had to change their attitudes towards, they were engaging with their customers, they were engaging with central banks, with other banks, etc. The bank's decision-making processes had to change. So there was a lot of external criteria put on the banks from the central bank and from the Department of Finance to say that the previous methodologies for accessing and looking at credit are inadequate, and we need to have much more structured ways of looking at credit. And the downside of that, of course, is that previously the banks prided themselves on we give you a very fast response, etc. And that quite clearly wasn't going to happen anymore. They had so many criteria they themselves had to go through. The banks, in terms of a herd mentality, what we mean there is, when everyone was chasing down business, when they were chasing down the property stuff, everyone ran after it. And then just as when the whole thing fell over, when they had a lot of problems, they all ran away from it. So it was either a pendulum, so we were really into this business, and then it was we're going to be out of this business until we get ourselves organised and we're going to come back into it. And how we're going to come back into it was a challenge for the banks. One of the great, in terms of one of the decision makings around the banks when they're looking at credit, one of the big decision making criteria is around credit grading. And credit grading is influenced by your track record. So your track record, if you've been working in a tight industry, you've been having challenges yourself, generally cash might have been a struggle for you, and on that basis you might have been sliding down the credit grading, and on that basis, looking forward, your credit grading will influence how the banks are going to assess applications from you into the future. And then the other issue is there's a lack of capital for alternative providers for contractors. So I think people were a bit worried about contractors. They had got burnt. They felt that this is a business that we're a bit concerned about, and it has only taken them really until now to sort of get over that, and how they were going to look at and what kind of customers they wanted to finance. In terms of the banks, their balance sheets were their core issue, and they had significant amount of challenges. So coming from a position whereby we had growth, and the mantra was very much about customer service, about customer, what we can do for the customer, they found themselves in positions where their balance sheets were extremely compromised, and they had huge capital balance sheet issues. They needed to deleverage their balance sheets. How did they do that? Obviously, the banks would get back some of the debt that's out there. A lot of it was problematic debt that they had to go and work at. They had to develop new strategies around how they're going to deal with all of that. And some of them then would have gone involved and sold a lot of their loan books. So if you look at where the flutter of banks and finance providers that were in the market in, say, 2005, 2006 to what's there now, the market, the environment has completely changed. I think from the banks, when the whole thing fell over, probably 07, 08 is probably remembered as that time when the banks suddenly realised that even they themselves realised the scale of the problem. What they had to focus on was their survival. Now, some banks could exit because they weren't core, their business in Ireland wasn't core to them, so they left. Other banks had to try and deleverage themselves. They had to, how were they going to get the debts back out to customers who were quite clearly themselves stressed? And this was a huge problem for the banks. And I worked in the workout area in the banks in the early 90s. And the issue that faced the banks in 2006, 2007 is absolutely extraordinary. No other countries had to face the scale of the problems that they had to face. One of the issues was that they had customers with a lot of track records to no fault of their own, but still they were very stressed themselves. In terms of the position of the banks, I think it's well known that a lot of the balance sheets were over concentration on property and over concentration on related types of industries. So their appetite for property and construction was diminished, and they were very much into focusing on what areas are we going to concentrate on. The other big issue about bank balance sheets now is that there's much stronger portfolio management. So in other words, there will be a certain amount of balance sheet that they will allocate to various industries, including the property sector. The banks, as well as those challenges, have had to change themselves. They've changed their experience with branches, how they interact with customers. A lot of the elder people in the bank, they've left, they've gone out on voluntary severance, they've gone out on early retirement schemes. So a lot of the experience that was there within the banks, and particularly at the smaller end, in other words, when you're engaging with your local branches, has been diminished because they've lost a lot of experience. And the big issue in the banks now is their compliance and process driven. So if you are in the bank now, you have a huge amount of regulation sitting on you that really drives your behaviour. The position of the specialist contractor, again, our co-founders, our joint venture partners in the UK, they have a significant amount of their book is in dealing with property and property-related industries. And here in Ireland, it's very difficult to have access to capital if you're in that industry. The interaction with the branches is completely different than I see most people here are quite experienced themselves. So if you go back to where you are 10 or 15 years ago and how you dealt with your branch manager, how you dealt with the bank, that has fundamentally changed now. The banks have had to reorganise their own way of doing things. They had to reorganise their model. They brought in business centres. At the local level then, how do you get access into capital if you're not a significant scale is an issue for customers. It's very difficult for contractors, we know, to monthly cash flow. So if you're involved in a number of projects with varying degrees of cash flow strains and cash flow critical paths, it's very difficult for you to forecast for yourself, and very difficult for your ability to plan, It's difficult for, if you don't have access to capital to go on to the next job, how do you get that next job? And it's that conundrum within the industry that we're trying to address. And it's very difficult when you're looking at tender strategies and uncertainty, because quite clearly, if you have a number of people working for you, the big question is, do you stay quoting for business even though it's a lesser, very small margin? Now, it probably went on certainly over the past 4 or 5 years, where people just survived. So you'd have to say that people who have come through this enormous experience and this quite stressful experience, people who've survived up to now really are the ones that in the future are going to be poised to benefit from the uplift. There's a lot of extra, no more so than the banks, there's a lot of additional requirements on contractors such as Syria, etc. I'm sure themselves within the industry, looking at reading any of the contracting reports, they talk about the lack of skill shortages because a lot of people have left, maybe emigrated and have gone out into the industry. Particularly in relation to this grouping, I guess there are people here who probably have been in the industry maybe 15, 20 years. There were people who were late entrants into the industry, and they were able to do well when the property market was going up, but they have all been squeezed out. And then finally, a lot of contractors and a lot of property related people probably have themselves either have their debt either sorted out, or they may have legacy debt issues themselves, which is probably restraining themselves from moving forward in relation to their core business. And one of the things that in relation to the banks, quite clearly, if you have a director or a company that has had legacy debt problems in the past, that sort of influences the bank's decision. If you are dealing with a director of the company who has personal debt issues, it can influence them when they're dealing with the actual core business then when it's looking for its own cash. So what are the financing sources for specialist contractors? I suppose the easy first one is equity. And if you have equity or someone can put equity into a business, then fine. But people have come through a very stressful time in the last 5 to 6 years. It's very difficult to see how people have loads of cash to inject into their business. The pillar banks, there are an awful lot less players. There's the 2 pillar banks remaining, and the 3 pillar banks with Ulster Bank. They're in the market. All the others have various strategies themselves in relation to what positioning they're going to do in the market, whether they have a strategy around focusing on certain sectors. In terms of the banks then, the types of finance that's available would be asset finance, the leasing companies, etc. There's a lot of term debt that's available that you can get long-term financing. Overdraft is essentially working capital lines. The other facilities that they have is invoice discounting, and again, when I worked in invoice discounting and I ran that company, essentially what invoice discounting was you had a number of, let's say the debtor book of around $1 million, we would look at the debtor book and we'd say, well, 20% of it we will discount because it's either raised or we don't like it or it's contract related, etc. And then we'd say there's 800,000 left, and we'll do 80% of that, which gets you about 650,000. They are still the major banks still have an invoice discounting arms. In relation to factoring again is another upstream form of invoice discounting where they take over the entire management of the debtor book. So they actually engage with the customers. They provide the working capital lines, but they're the ones who have direct contact with the customers. There are various funds that have come into Dublin who are notionally there to provide financing and capital for SMEs. Now generally these funds are only looking after very large players because obviously they have an investor group, they have credit committees, they need to have that sort of engagement, that sort of scale before they're going to get involved in small scale companies. The Strategic Bank Corporation of Ireland is the government initiative, and again they have come in, the Minister of Finance launched that, and they are charged with looking at those SMEs who have difficulty getting money from existing finance providers, and they'll be doing it on a more favourable rate. And they've only set up now about 6 weeks, so it'll be interesting to see how they get on. Third banking source, again, I guess the government has spent a lot of time trying to develop an alternative in terms of the third banking source. And they were, in the newspapers we talk about Ulster Banks and PTSB. PTSB are trying to develop their capability in that area, looking at SMEs and how they want to develop a capability for them. NAMA, you have to mention NAMA because they are such an enormous feature of the Irish property market. They're the largest construction company in the world. They have a requirement to get the money back for the taxpayer, but also they have a very strong impetus to provide financing for property and construction. The invoice discounting and factoring providers, there's quite a number in Ireland as well as the major players. They again generally are operate, the thing that you need for invoice discounting, obviously you need to have a qualifying debtor, you need to have, and generally they do contracts, so you work with them at a certain level. So when I ran the company, I had a fixed cost base, so by definition you need to have a minimum level before I was interested in getting involved in financing that. And that's what the invoice discounters work. They have a kind of a minimum level, like below that it doesn't make an awful lot of sense for them to be providing finance out to companies. And then finally there's ourselves and other companies like in the UK who do single invoice discounting. So single invoice discounting, as I said earlier, when I was running the invoice discounting company, I was financing a debtor book. So I had a debtor book of $1 million, whatever. And what we do is we finance single debtors. So if there's a debtor that we can finance, we go in there, we look at that specific debtor, and if it's a once-off provision of facilities, then fine. We don't ask you to come in and do any kind of a contract. We're only interested in looking at those particular debtors. So it's generally a lot of our customers we'll be talking about using on an occasional basis, or else we are an add-on or a backstop to existing facilities. So if you have some of our customers, for example, are those who have working capital lines in the banks, and the working capital lines, they're happy enough, they don't want to really increase beyond that level. And we will come in and we will provide that financing for a single debtor, a single transaction, and we are there as a backstop facility then. So we are in partnership with the main finance provider, so we're not really a threat to the main banks. We see ourselves as an adjunct that whenever there is a requirement for an additional bit of facilities, rather than going into the banks, you can come along and we're an option for you. We're looking for solid companies with a strong track record of success, the companies that have profitable, have a future, and they're in need of some cash. And again, we recognise that a lot of companies in this sector have come through the wars themselves. If there are previous problems, that's not something that we're going to be, that's going to rule out anything for us. We'd say we look at the proposition as it stands on its own. And again, from our perspective, it's all around getting to know the customer. Whilst it's sold as a kind of a look, we will go in and finance that one debtor. The reality is that customers come back and use us, because once we get to know you, then you can have the money within 24 hours. And that's the service that we provide to our customers. That once we're in there, they can have the money more or less because we've done all our due diligence, etc. So from our perspective, we get to know our customers. We really want to get out there and see what's get under the bonnet, as it were, and just get a relationship going with our customers. That's my bit. I'll just hand over to Brian, who's going to talk through some of the examples that we have done so far.
Okay, thanks very much, Robin. Good morning, everybody. Yeah, that's just a bit of background, I suppose, in terms of the dynamic, what everybody has been experiencing over the last couple of years. It has been difficult, it has been challenging, and as Robin said, I'm not going to repeat what he said, but basically, I suppose we looked around, we in terms of the experience that we have, we looked around to see how could we play in this market, and I think we found a very good partner in Catalyst Finance in the UK. They've been going about 4 or 5 years at this stage, very good industry players. They have people working with them from various parts of the finance industry, very deep funding. In terms of our operation, we have our own experience that we've had for 25, 30 years in finance. We have access to funding ourselves. We put some of our own cash into this business. And we've access to capital locally in Ireland, but also we have our partners in the UK in terms of funding as well. So we have a capability to, we're not going to be competing with the big ones, but we see ourselves as playing a role, which I think is very important. The more players we can get into this business, into helping get this economy going, the better it is for everybody. So what I'm going to do is just to walk through a couple of examples. And the first one was a specialist electrical contractor. This was probably, we started our business last September. It was one of the first cases that we did. Basically, they were with Ulster Bank. There was legacy debt associated with the business. The director is personally liable for that legacy debt related to buy-to-let properties and so on. Working through that particular challenge, I suppose, with Ulster Bank, but taking time to get through it. Notwithstanding that, they had a business to run. The overdraft was at their maximum limit, and really there weren't any further funds available from the bank at that time. They were out there, they were tendering, the margins were a bit tight, but things were starting to improve. But these guys were specialist operators, and they were invited to tender for an opportunity with a major multinational, US multinational. The contract value was worth in the order of 130,000. There was a very strong gross margin on it because of the nature of it. It related to a clean room, fire prevention system within a clean room. Equipment had to be bought and gear had to be bought from abroad. The supplier for that particular equipment needed to be paid in 30 days. He had guys on the ground that needed to be paid on Friday. And this particular multinational that he was putting the kit into, their credit terms, again, it was a US operation. They weren't going to change it for him, but it was 60 days. So he was short and caught for a period of time. We were approached, we looked at his situation, we did our due diligence, we got the introduction through an accountant, so we knew the accountant, so we were happy with the referral source that we were getting. We did our due diligence, and within about 5 days we had it pretty well done. We knew what we wanted. We had a strong takeout in terms of the invoice was going to be paid within that duration from that multinational. Overall, the funding cost, we provided 85,000. That's what was required for 35 days, and the cost of that, and it is a transactional cost, came to 4.5, but it's still allowed on an individual basis for the individual to go and take the contract, make money, and particularly with that US multinational we seem to be delivering. That's an example of a situation, I suppose, where legacy debt was dragging down the business, dragging down the ability to try and get on and do business, and strengthen the company's balance sheet and cash flow. The second one was slightly different, probably maybe less financial problems, but it was all around, I suppose, relationship. As Robin has mentioned earlier on, the dynamic has changed inside of the banks. The idea of going into a branch manager or going to a business centre and getting to know somebody and they knowing your business has kind of moved on a little bit. A lot of that is because of the experience gone, but also probably the good remaining experience has been brought into the debt recovery side of the business. So getting somebody to listen to your proposition and listen to your business case becomes more and more difficult. Again, there was a profitable contract, limit was at the bank, application required updated information, and again, like all of these things, looking for compliance requires them to have a lot of boxes ticked before that's done. Time was moving on, we were approached, and in that situation, 70,000 was required for a 40-day period. Again, we were able to get the cash out within 5 days, and it was in their account by day 6. And we've actually done a second transaction with them since. And that's really down to convenience and flexibility and responsiveness, which is what we would very much trade on. The business is these two guys here, and we've got somebody down south that's working with us as well. We're committed to the business, and we will meet individually, sit down. We're not dealing through a call centre, we're not dealing with through a website or whatever. We will meet with people, we will sit down and go through the numbers and understand the business. And if it makes sense, and the margin is in it for the individual company that we're looking with, we do the business. It's as simple and uncomplicated as that. We are the credit committee, and we take the risk and we do it. Just a final case example. Robin mentioned that our partners in the UK, actually this business and this single invoice financing business emerged out of the US, largely out of the construction sector, interestingly enough. And our partners in the UK would have probably about 50, 60 transactions. It's not transactions, sorry, relationships on a regular basis with the construction operations in the UK. CRT Construction, they were in the plastering rendering business, London and the southeast. Again, they'd reached their limits with a previous funder. They took the client and doubled basically their financing facility. They were happy to look through and say, look, the contracts that they have down the line gives them the flexibility to go and do it. So it gave them that kind of certainty to tender and go forward on a contract by contract basis. So we're lucky in the sense that, I suppose, like, you know, coming from the industry that we've come from in terms of banking and what's happened in your industry, there's probably a lot of there's a lot of, I suppose, caution. But with our partners in the UK and the experience that they've had, they're probably about 3 or 4 years ahead of us up the curve. We've been able to tap into that and probably get an understanding that has been very useful from our point of view. That's pretty much it. I just wanted to quickly run through a couple of case examples that we've been involved in. We'd be very much interested in hearing from yourselves the kind of issues and challenges that you're facing out there. And if we can, you know, to call a spade, if we can do anything, we'd be delighted to have a conversation with you. But thank you very much. There are our contact details there, and there are further details to you. Okay? Thank you very much.
Thank you.